There's a condo complex in Normal Heights right now where most buyers cannot get a normal loan. Not because of the units, not because of the neighborhood, but because of a report that the Homeowners Association has never ordered. In early August, a rule change landed that makes this harder for every condo buyer in the county. Almost nobody has covered it. Today, I'll show you what's going on, why it's quietly reshaping our condo market, and what it means for you whether you're buying one or you're already owning one. All this and more covered in this week's San Diego Market Matters, and I'm Karl, your San Diego Realtor. If you haven't subscribed yet, consider doing so now so you can stay up to date on the grounded read of the San Diego housing market. Now, let's get into this. Let's kick things off with your quick market update because this is the backdrop that sets up everything that's going to follow. Starting with inflation, the Fed watches a measure called PCE, and the June reading came in at 3.7%. Their target is 2%, so we're still above it and quite a bit ways off. But the direction finally turned. A couple of months back, that number was well over 4%. Unemployment for July landed at 4.1%. Stable labor market, not booming, but at the same time not breaking. Then second quarter GDP came in at 1.5%. Now that's real growth. It's slower than earlier this year, but it's still growth. The economy is cooling, but it's not falling over. Now, the one metric that moved some. There's a tool called the CME FedWatch tool. We report on it regularly. It tracks the futures contracts to show what the market expects the Federal Reserve to do at their next meeting. Think of this as the market's best guess. Heading into the September 16th meeting, the market puts about a 60% chance that the Fed holds the rate where it is. And there's a 0% chance of a cut. And there's roughly a 40% chance the Fed goes the other way and raises the Fed Fund Reserve rate. Sit with that. Not one contract is betting on a cut. A month ago, the market's favorite outcome was a hike. So if you're waiting on the Fed to fix your payment, that's not what the market is pricing, which brings us to mortgage rates. The 30-year conventional fix is sitting around 6 3/4 as of Friday. Over the past year, this rate has run between 6% and about 6.85%. So today we're near the top end of that band. And here's what a lot of people miss. FHA is at 6.33% and VA is at 6.35%, meaningfully lower than the conventional. If you thought every rate started with a 7, you're way out of date. So as of right now, there's no rates coming and rates are near the high end of where they've been all year. The buyers most exposed to that are condo buyers. And in San Diego right now, condo buyers have a second problem that has nothing to do with these rates. There's a state law called Senate Bill 326, and we call it the balcony law, and it came out of a 2015 balcony collapse in Berkeley that killed 6 people. This bill requires homeowners associations to have their elevated structures inspected by a licensed professional. That includes balconies, decks, exterior stairways, walkways, anything holding people up off of the ground with wood underneath. The deadline for that first inspection was January 1st of 2025. Here's where boards got confused, and the confusion is doing real damage. A follow-up law, Assembly Bill 2579, pushed a deadline back. That extension applied to apartment buildings under a different law though. It did not extend the deadline for condominium associations under the SB 326. So the boards read a headline, they believed they had more time, and then they did nothing. They did not have more time. An association that missed January 2025 is not in a grace period. It is one out of compliance, and it has been for over a year. That breaks 3 things at once. Under Civil Code Section 5551, the report has to be folded into the association's reserve study. So without it, that study is legally incomplete. Insurance carriers are demanding proof of compliance before renewing the master policy on these buildings. And lenders are rejecting loans where there's no valid balcony safety certificate. Read that last one again. Your buyer can be fully approved, perfect credit, money in the bank, and the loan still dies because of the document the association has never ordered. So what happens when a complex fails that review? This is where buyers get hurt, and they get hurt pretty badly. There's a word lenders use, and that word is warrantable. A warrantable project meets Fannie Mae and Freddie Mac standards, which means your lender can sell the loan to them. That's what makes a normal rate and a normal down payment possible. A non-warrantable project fails those standards. Deferred maintenance does it, then reserves does it, big special assessments do it, active litigation does it. When that happens, conventional financing goes away and so do FHA and VA options. What's left is a portfolio loan where the lender keeps it on their own books instead of selling it off. There's a condo complex in Normal Heights called Suncrest. Most conventional and government-backed loan financing is completely off the table there right now. The only thing we've been able to find are portfolio loans on a non-warrantable project, and that is the only option if you want to buy in that complex. So let me lay out what one of these costs because the pieces stack on top of each other. First, there's the interest rate, 1 to 2 points above conventional. A normal 30-year is 6.77 today, so you're looking at something starting with a 7 or even an 8. Second is the down payment, 20 to 30% instead of 3 to 5%. Our attached median is $659,000. 20% of that is about $132,000 in cash. 30% of that is closer to $200,000. 3% would have been under 20. Third, it's the term, 15 or 20 years instead of the 30. Shorter term, same loan, but a bigger payment. So we have higher rates, higher down payment, higher monthly payment because of the term. That's a triple threat, and all three land on the exact same person trying to buy this condo. And that's not even including HOA fees. Now think about who buys the attached space in San Diego. It's first-time buyers and entry-level households. That's what condos and townhomes are in this market. They are the on-ramp to home ownership in San Diego. The buyer in this portion of the market does not have $132,000 sitting in cash. That buyer is also already stretched at 6.77%, so a rate starting at 7 or 8 prices them out by itself. And that buyer needs the longest term they can get to keep the payment survivable, not the shortest one. Nothing about a portfolio loan is built for a person who shops this segment. It's a product for someone with deep cash reserves and high income. So when a complex goes non-warrantable, it doesn't only get harder to sell, it changes who's allowed to live there. Now let's talk about the complex version of this, because this is where it stops being about one unit and starts to become hundreds. Picture a complex built in the 90s or even earlier. Wood balconies, wood walkways, 30 years of weather on them, and a board that never ran a real preventative maintenance program. They deferred, and because deferring is cheaper this year, the bills kept landing and eventually piled up on someone else's watch. That bill has finally landed, and it didn't land on one unit. It landed on the whole complex at once. Let's say the inspection finds problems across 40 balconies. Repairs at scale cost real money, and these associations don't have it in their reserves, because not having it in reserves is how they got there. So the only lever the board has is a special assessment, a bill to every owner on top of their actual HOA dues. At this scale, those are not small. They hit a household like a used car, sometimes even worse. And passing that the repair is gonna get done doesn't fix anything. It just starts a clock. Somebody still has to do the work on 40 balconies with a licensed contractor in a building full of people who live there. That's gonna take months. This is the part that decides whether you can sell. The complex doesn't become financeable when the money is raised. It doesn't become financeable when the work starts. It becomes financeable on the day every one of those elements has been brought to the standard and passes an inspection. Until then, the whole complex is stuck. Your unit might be immaculate, but it doesn't matter. So what areas per se? Probably anywhere in this county with attached units built in the 90s or earlier. The one I carve out is Mission Valley north of Friars because that's mostly newer construction. But south of Friars tends to be older, so those areas are vulnerable. So you have to wonder, what does this all do to the market? Well, let's look at the attached side of our July numbers because the fingerprints are right there. New listings for condos and townhomes came in at 1,331, down almost 4% from a year ago, and that's 2 months running in a negative territory. For most of the past year, that number ran positive. Now think about what that stuck complex does to this number. It doesn't list. Those owners aren't selling because they can't sell to anybody carrying a normal loan. Those units never reach the market at all. Now, run this thought experiment with me because this is where it gets interesting. Now picture San Diego with no SB 326. Every one of those stuck complexes is now financeable. The owner who wants out lists. The owner who's been waiting 3 years to move, they list. The complex staring down a special assessment nobody wants to pay, those owners list too. All of it hits the market and not spread out over 5 years. It all hits at once. So let's start with inventory. That new listing number is no longer down 4%. It's up and up meaningfully because you've released units that were locked in place. Then we can take days on market. Attached is sitting at 43 days and year-to-date attached time is already up almost 13%. Now add a wave of new competition against that same pool of buyers, that 43 days goes up, not down. Every one of those sellers waits longer because they're standing in a longer line. And then there's price. Year-to-date, the attached median is down 0.7%. That's pretty soft, not broken at all. Now flood that same segment with supply while rates sit near the top of their 12-month range and buyer demand hasn't moved. 0.7% turns into a bigger number and it stays there longer. So the market you're looking at right now, thin listings, slow sales, slightly negative pricing, is the version where a law is holding a chunk of inventory off the board. Take that law away and every one of those 3 lines gets worse if you're the one who owns a condo. Now I wanna be careful here because nobody's measured this and I can't tell you how many units SB 326 is holding back in this county and neither can anybody else. But the direction isn't a mystery. Supply that can't list doesn't compete and supply that can't compete doesn't push prices down. And this brings me to the part I keep going back and forth on. SB 326 cuts both ways. And which way depends entirely on which side of the table you're sitting on. If you own a condo here, this law has quietly been working in your favor. Every stuck complex is a competitor that never showed up against your listing. If you're trying to buy one, it's the opposite. Those units would have meant more choices and a lower price on one part of San Diego still reachable for a first-time buyer. This law pulls supply out of the exact segment that is needed most. Same law, one group it protects, one group it prices out. So here's what I want you to do with all of this. If you're a seller or think you might want to someday, don't wait. Go to your HOA now and ask where the association stands on SB 326. If the work hasn't been addressed, push to get it started in phases instead of waiting for one enormous project later. Balconies don't get better sitting there. Small doses budgeted over time are far more feasible for a complex than a single crisis assessment after everything has fallen apart. If you're a buyer, this belongs to how you shop, not only how you close. Here's what I do with my own buyers. Before we get anywhere near an offer, I walk them around the entire complex, not just the unit, the whole property. We look at how the grounds are kept, the condition of the walkways, the paint, the landscaping. That tells a surface read, and it tells you a lot about how the board runs the place. Then we go into the HOA finances, what the reserves look like, what work is on the calendar, whether there's a real preventative maintenance plan, or whether the plan is to hope. A well-run association shows you both. A poorly run one gets vague and a little grayish. So that's the week. No Fed funds rate priced in, rates near the top of their 12-month range, and a condo market where the association paperwork now decides whether the deal actually gets funded. So I wanna know what your thoughts are on SB 326. Is it a blessing in disguise that quietly controlled our inventory volume and protected condo values? Or is it devastating this market and what it costs to keep those complexes standing? Let's hear what you think, and I don't know if there's a clear answer on this, to be honest. And that's a wrap for this week's San Diego Market Matters. If this video provided value to you, please consider liking and subscribing to the channel now. And if you're thinking about buying or selling here in San Diego, my contact info is in the description below. Feel free to reach out to me. I'd love the opportunity to work with you. As always, I'm Karl, your San Diego realtor. I'll see you in the next video. Shh.